Welcome Highlanders to the discussion section video for week 9 on the money multiplier and monetary policy. It's usually my custom to do these discussion section videos on the parts of the chapter that I think are hardest for students, so they get a little bit additional practice on the hardest material. However, with this chapter, I don't think there's anything that's particularly difficult to understand. I did try to throw in the only math in this chapter in terms of calculating the money multiplier, and then just focus on monetary policy because that's the part of the chapter that we're going to need moving forward into the last chapter of the class, chapter 14. It's also the one that I think is most relevant in terms of current discussion about how the Fed operates within the economy. So I'm kind of focusing on, I guess, the most relevant stuff rather than the hardest stuff, only because there isn't really anything in this chapter that I think is harder than anything else. But with that in mind, let's go ahead and start talking about fractional reserve banking, the required reserve ratio, and the money multiplier. So as I mentioned in chapter 13, remember that banks do not hold on to 100% of their deposits. They only hold on to a fraction of those deposits and then lend out the rest. So again, if you put, say, $10,000 in the bank, right, the bank's only going to hold on to some percentage of that $10,000, right, based on whatever the Fed requires, and then they're going to loan out the rest. Now, the bank can choose to hold on to all 100% of your deposits if they wish, right? But again, they make money by loaning out money to other people. So the more money they loan out, then the more money that they're going to make or profit. With that in mind, the reason why that is true is because the interest rate they give you on the money that you put in your savings account is far less than the interest rate they charge people for borrowing money from that same bank, right? So again, it's like buying something from somebody for a lower price and then selling it to somebody else at a higher price. That's essentially what the bank's doing, is they're getting those loans from you and paying you a lower interest rate, and then they are giving that money to somebody else and charging them a higher interest rate. And again, the more that the banks can loan out, the more money they're going to make. Having said that, the percentage of all deposits they have to hold on to as bank reserves is called the required reserve ratio, and that is set by the Federal Reserve. So remember, Bank of America or any other commercial bank can keep money in their vault, and they certainly do. And then they can also keep money in deposits with the Fed in the same way that you can keep your money in terms of cash you have in your wallet, and then you can keep money also with deposits you have with your commercial bank. So with that in mind, again, a bank wants to loan out as much as they can, but they are required by law to hold on to some money, right, so they don't leverage themselves too highly, and so that they can give you your money back if you want to go in and collect it. Right. Remember that if you were to go into any commercial bank and ask for all of your money back, chances are they would have it. If everybody all at once went into the bank and asked for their money back, the bank wouldn't have it, because most of their money is, again, in other people's homes, businesses, and college educations, as they've taken out loans for those activities. Now, the potential deposit expansion multiplier, which again is a mouthful to say, so we usually call it the money multiplier, which we just abbreviate as MM, is equal to the inverse of the required reserve ratio, which again we just abbreviate as 3Rs, right? So again, the money multiplier is 1 over that required reserve ratio. So if that required reserve ratio is equal to, say, 0.20 or 20%, meaning that the banks have to hold on to 20% of your deposits, then that money multiplier is going to be equal to 1 over 0.20, which is equal to 5, right? So every $1 increase in the money supply by the Federal Reserve could result in as much as a $5 increase in money supply as a result of this multiplier effect, right? Now remember that this is called the potential deposit expansion multiplier, because this is as big as the effect could possibly be, and in other words, the biggest potential effect that we could have, right? But it might not necessarily be that big if people choose to hold on to money instead of putting it in the bank, or if the bank chooses to hold on to their excess reserves rather than lend them out. Right? Now, if the required reserve ratio were to go up, then the size of the multiplier would go down. So if the Fed wanted to restrict money supply, then they might raise the required reserve ratio from 0.20 to, say, 0.25, right? In which case the money multiplier would be equal to 1 over 0.25, which is equal to 4, meaning that when the Fed increases money supply by $1, it can create as much as $4 worth of additional money supply in the economy as a result of this multiplier effect. So if the Fed wanted to use expansionary monetary policy to increase the money supply, then one thing that they might try to do is lower that required reserve ratio to increase the size of that multiplier. Right? This will force banks to keep less money in their vaults or in deposits with the Fed, which allows them to loan out more and takes advantage of that multiplier process. So if they lower the required reserve ratio down to say 0.10, so that banks only have to keep 10% of their deposits on hand, then the money multiplier is going to be equal to 1 over 0.10, which is going to be equal to 10. So every $1 increase in money supply from the Fed could result in as much as a $10 increase in money supply after it goes through this multiplier process. Right. So again, if the Fed wanted to use restrictive policy, it would raise the required reserve ratio. If it wanted to use expansionary policy, it would lower the required reserve ratio. And that brings us into our discussion of monetary policy. I'm just going to briefly review the summary that we talked about at the end of chapter 13 here. Now remember, the most common way that the Fed is going to conduct monetary policy is through open market operations, which is the buying and selling of government securities, also known as bonds. Right, so if the Fed wants to increase money supply, then it's going to purchase government bonds. That means that it's going to take these bonds, which are just pieces of paper, out of the economy and replace them with the cash, which again are just other pieces of paper, right? But ones that have a more immediate value in terms of exchanging it for other goods and services. Right, so again, the Fed's going to take bonds out of the economy and put cash into it. That's one way that the money supply, or the amount of money circulating throughout the economy, will increase. Now, if the Fed wanted to use restrictive policy, then it would sell those government bonds. In other words, it would take cash out of the economy and replace them with these bonds, which is a promise for cash later. Now, another way that they could affect monetary policy is what we just talked about through those reserve requirements. Lower reserve requirements result in a bigger multiplier, so that's going to increase money supply. Raising the reserve requirements results in a smaller multiplier, so that would restrict or lower the money supply. Now remember that the Federal Reserve can extend loans to commercial banks in the same way that commercial banks can extend loans to you, right? And just like how you might be less eager to borrow money at higher rates and more eager to borrow it at lower rates, right? That is true for commercial banks when they're dealing with the Fed. So the Federal Reserve will lower the discount rate in an effort to extend more loans to banks. Again, banks being more eager to borrow money from the Fed at these lower discount rates or lower interest rates that the Fed is charging these commercial banks. And that is one way that the Fed can practice expansionary policy. So again, the discount rate is just the rate at which the Fed loans money to commercial banks. The lower that rate, the more commercial banks will borrow, giving them more money to circulate throughout the economy. Now, if the Fed wanted to use restrictive policy, it would raise that interest rate or discount rate that it charges these commercial banks. That will make these banks less eager to borrow money, and therefore the Fed would be extending fewer loans. Right now, the Fed also pays interest on excess reserves that are deposited there at the Fed. So when Bank of America puts their money at a Federal Reserve Bank, then again, they can get interest on the money they have with that Federal Reserve Bank. And if the Fed wants to use expansionary policy, then they're going to discourage banks from putting their reserves and deposits at the Fed because they want those banks to loan it out instead. So they're going to reduce the interest paid on these excess reserves. Now, if they want to lower the money supply or use restrictive policy, then they're going to increase the interest that they pay on these excess reserves because that's going to encourage the banks to put more money in deposits at the Fed rather than loan it out or circulate it throughout the economy. So those are the 4 ways in which the Fed can conduct monetary policy. Make sure you know those for the quiz or exam. Now I'm going to finish this video by talking a little bit about some current policy that's been happening, at least recently, within the way that the Fed has been conducting their business. So this is from the Monetary Policy Report from February 7th, 2020. Right, there's a link if you want to check it out. But it says that the U.S. economy continued to grow modestly last year and that the labor market strengthened further. Again, that when we say labor market strengthened, we mean that the unemployment rate has gone down. With these gains, the current expansion entered its 11th year. So that's 11th year of an expansion here since that Great Recession of 2009. This is becoming the longest on record. So this is one of the longest expansions that we've entered into. However, one of the big issues with expansions is the potential for inflation. But according to the Federal Open Market Committee, or again, that group of individuals at the Federal Reserve who's in charge of making these open market operations, Remember, those include the 7 board of governors and 5 bank presidents, the one person from New York and then the other 4 rotating there. But according to this committee, the long run objective of 2%, which is what they try to keep inflation at, as it turns out, inflation was actually lower than that long run objective. So they're saying we're not too worried about inflation, even though we are entering the longest expansion on record. So in light of this, what they've done is decided to keep these interest rates relatively low. So it says, in light of the implications of global developments for the economic outlook, as well as these muted inflation pressures, right, the Federal Open Market Committee lowered the target range for the federal funds interest rate at its July, September, and October meetings, bringing it to a current range of about 1.5 to 1.75%. Right, so basically what they've done is they've kept these interest rates low, right? Even though the economy is doing really well in expansion, we're not worried about inflation, so they're keeping interest rates low to further stimulate this expansion. Now it says in the committee's subsequent meetings, it judged that the prevailing stance of monetary policy was appropriate to support the sustained expansion of economic activity, the strong labor market conditions, and inflation returning to the committee's symmetric 2% objective. Right, so again, this is a very long-worded way of saying that the Fed is going to continue to use expansionary monetary policy by keeping these interest rates low, even though we are currently in an expansion, right? Because they want to keep this expansion rolling, and inflation doesn't seem to be creeping up to the 2% level that they try to maintain, right? So with that in mind, more recently, during this coronavirus pandemic, where we are suffering from an economic decline, this is April 29th, which was the latest report I could get regarding the Fed's behavior. Right, again, you can check out the link there. It says that they've actually lowered interest rates even further. Interest rates will remain at 0% until the financial effects of the coronavirus pandemic begin to subside, which is good news for some consumers, right? And again, this was announced on Wednesday, April 29th. It says the central bank has taken a number of steps to help Americans, including some that encourage lending, but keeping interest rates at 0 is another way policymakers are intending to stimulate economic activity. So again, because we've hit this very dark economic time, or this contractionary period as a result of these social distancing measures due to the coronavirus, the Fed has actually lowered these interest rates further to try to stimulate the economy. Now, this does have both positive and negative effects. If you're somebody who's trying to buy a house right now, you might notice that the loans, the interest rates on your mortgage loans that you can get are really, really low. And this is going to encourage people to go out there and buy more homes. Same thing with regards to if you're carrying a lot of credit card debt, this might make the interest rate on your credit card debt a little bit lower, right? So if you are a borrower, this is a good thing for you. Having said that, if you are a lender or what is known as a saver, then this could have a negative effect. And the Federal Reserve Chairperson Jerome Powell acknowledged that. He acknowledged this negative effect for savers during a press conference on the same Wednesday, April 29th. He says, but the central bank needs to consider the well-being of the broader economy. So in other words, we need to look out for the borrowers as much or more than the savers, and we need to encourage people to stimulate the economy at this time. So again, they cut rates to 0 over the course of 2 emergency sessions that they held in March. Now it says the policy makers said that they would remain in this current range until the body is confident that the economy has weathered these recent events, is on track to achieve its maximum employment and price stability goals, basically saying that we're going to keep interest rates low here until we try to return back to normal. It says the ongoing public health crisis will weigh heavily on economic activity, employment, inflation in the near term, and poses considerable risks to the economic outlook over the medium term. Right. Again, this was declared by the Federal Open Market Committee on the same Wednesday. Right. So with that in mind, the next Federal Reserve meeting will take place in June. So we'll kind of see what happens then. Right. But until then, right now, interest rates are particularly low, and the Fed is doing this in an effort to stimulate the economy. Right. So again, that's an example of some monetary policy currently in practice. Right. Now, again, some things that people might need to be worried about here is that this could start causing some inflation sooner rather than later, particularly as we keep dumping trillions of dollars into the economy through these relief and stimulus measures. So that might be something you want to keep your eye on there, particularly if you're somebody who's saving your money. Right? Remember, when inflation is higher than anticipated, savers are hurt. But when inflation is lower than anticipated, right, is the lenders that gain, right, and the borrowers that lose. right? But right now it looks like inflation might be increasing more than we thought it would, which again would help the borrowers at the expense of the lenders. So with that in mind, once you feel comfortable with this kind of information, basically monetary policy and the idea of the multiplier, money multiplier, and how that relates to the required reserve ratio, then go ahead and complete the discussion session. Go ahead and complete the discussion session assignment on iLearn for this particular module. And as always, just let me know if you have any questions or concerns about this module or the class in general. We're almost there now. We're approaching the last week, so I hope you have been enjoying the class so far, and I look forward to talking to you all next time. Take care.